or in this class we are going to study the three methods of GDP calculation, or for that matter the three methods of national income accounting. Okay, just for your understanding, let me tell you, in the previous class we have understood what is national income, or what is GDP, how it is calculated, and what are the four attributes of national income. Those are GDP, okay, NDP, GNP and NNP. And we have also seen some concepts like GDP at factor cost versus GDP at market prices. Then we have also seen finally real GDP versus nominal GDP. Okay, so in this class we will try and understand the three methods of GDP calculation, or for that matter three methods of national income accounting. Okay, so I hope you know what are all the three methods of national income accounting. First method is product method, okay, and it is also called as value added method. Okay, second method is I think this also you know very well, it's called as income method. Okay, it's also called as factor income method. And the third one is expenditure method. Okay, expenditure method. Okay, so in all the three ways we can calculate the national income, but practically the NSO, which is responsible for calculating GDP in our country, it uses a combination of these three methods that is not required from the point of view of examination. What you have to know is, theoretically there are these three methods which are useful for calculating the national income. So briefly we will try and understand each of these methods. Okay, so the first one we will take product method. Okay, here what we will do, we will take the, what is GDP? Simply, GDP is nothing but the quantity, okay, the quantity of goods produced, goods and services produced that are produced in the country, and their market value. Okay, market value, that is GDP, right? So in value added method or product method, what we are doing, simply we are taking the production process. Okay, we are taking the production process and we are adding the value, we are taking the value that is added at each and every place, each and every stage. So to better understand it, let me take an example. For example, I am wearing this shirt. Okay, it is a textile, and we will try and understand the steps that are involved in making this shirt. Okay, first you need cotton fiber. Okay, stage one is, there is a farmer and the farmer has produced the cotton fiber. Okay, for example, the cotton fiber that is required for making this shirt, maybe 10 grams or 20 grams, its value, let's think that it's some 100 rupees. Okay, right, the cotton fiber, then the farmer sells it to the manufacturer, some manufacturer. So there we will enter into stage 2. Somebody will purchase cotton fiber from the farmer, and from the cotton fiber the manufacturer will convert it into yarn. Okay, then of course when the fiber is converted into yarn, the amount of or quantity of yarns value, okay, that is required for making this shirt, let's think its value is 150 rupees. Okay, then in the third stage or in the next stage, what happens, another manufacturer, that person will purchase yarn from this person. Okay, and he will make it into a fabric. Okay, he will weave it into a fabric. Okay, For example, the value of the fabric that is required for making this shirt, okay, let's think it is 300 rupees, okay, let's imagine it's a 300 rupees, okay. Then finally after that what happens, the fabric is purchased by some other manufacturer, and that person will, this is stage 4, that person will convert this fabric into, or stitch this fabric into shirt, okay. So let's think the value of the shirt is, okay, 700 rupees, okay. Nowadays you will not get that much good shirt for 700 rupees, only for the example I am taking, okay. So value of the shirt is 70 rupees, okay. So quantity, let's imagine for our understanding, in our economy only one shirt has been produced and nothing else is produced. For our understanding, let's think that. And the market value of that shirt now, if this person, the person who has made this shirt, if he is trying it to sell, okay, to the retailer or directly maybe to the consumer, its market value is 700 rupees, okay. So quantity 1 into 700 rupees. So how much will GDP will become? GDP is 700, okay, right. So how it is done in value added method, we will now understand. So initial value you take 100 rupees, okay. So 100 rupees you will add. Cotton fiber value that is required in this, utilized in this process is called as, is 100 rupees, I am sorry. Plus, you see the price of the yarn is 150 rupees, okay. So do we have to take this entire 150 rupees? No, we should not. Why? Because this 150 rupees already, it is having this value of 100 rupees in itself, okay. So in this 150 rupees of yarn, 100 rupees worth of cotton fiber value is also there. So what is the value added in this stage, okay, when the fiber is converted into yarn? What is the value added? 50 rupees is added, okay, because here the price was 100 or value was 100, here it has become 50 rupees, okay. Similarly in this stage, how much of value is added? 150 to 300 means 150 rupees value is added. Simply you have to take the value of the good minus intermediary consumption. We will understand that word also, what is intermediary consumption, but for the time being we will understand how much value is added here, okay. So 150 is added from this stage to this stage, and finally when the shirt's value is 700 rupee, so how much value is added here from this stage to this stage? 400 rupees of value is added, okay. So in GVA, gross value added, what you will do, you will take the value added at each and every stage and you will sum it, okay. So initially there is no value, 0 value, then cotton fiber is produced, its value is 100 rupees, so you will take it. Then in this stage 50 rupees is added, in the next stage 150 rupees are added, and in the next stage 400 rupees are added. So at each and every stage you go on adding the value, okay, that is added to the product. So add it, 150 plus 50 150 plus 150 300 plus 400 700, okay. So you got the GDP or not, okay, you got the GDP was 700. Now in value added method also you got the 700 rupees, okay. This is how we calculate in product method or value added method, okay. So you see in this process, in making shirt, the fabric is considered as intermediate consumption, okay. Then in the making of the fabric there is a intermediate consumption, yarn is the intermediate consumption in making the fabric, okay. Then at any stage, if you want to find out what is the GVA at this stage, gross value added at this stage, you see this is called as GVA, total GVA. In the total GVA in the process of making this final product called as shirt. But at any stage, maybe at the yarn stage, maybe at the fabric stage, or maybe at the cotton fiber stage itself, you want to know what is the gross value added at each and every stage. Why? Because policy wise, if you have to interfere, you should know how much value is added at every stage, whether it is added at yarn stage, whether it is added at fabric stage, whether it is added at the final product stage. Accordingly, you can intervene through your policy. Okay, if value is added here more, maybe you can impose more taxes. If less value is added at some stage, maybe you will think of adding or imposing less tax. Okay, like that. So GVA is how you will calculate it. This is the value of product, okay, minus intermediate consumption. Intermediate consumption. Okay, then you will get the GVA. You apply this formula to every stage of the chain I have explained, value chain. You will get the value added at each and every stage. Okay, why I am emphasizing this much on gross value added? Because the government of India, okay, GOI, officially expressing the income figures or national income figures for agriculture sector in GVA terms. Apart from GDP figures, of course GDP figures are available, but apart from GDP figures, the government of India also giving a GVA for agriculture sector. Why? Because it wants to know that how much value is being added in the agriculture sector. If you take for this chain, up to which stage it is agriculture sector or primary sector? Up to this stage it is primary sector. Okay, cotton fiber production, primary. Okay, from here onwards it is secondary sector or industrial sector. Yarn, cotton fiber, yarn is produced, it is a manufacturing process. Yarn to fabric, it is also manufacturing. Fabric to shirt, it is also manufacturing. Then finally when it is sold to the, maybe this person is the producer, then he will sell to the wholesaler. Okay, then this wholesaler will sell to the retailer. Then this retailer will finally sell it to the consumer. Okay, there the aspect of service sector or tertiary sector will come. Okay, but I am not going into that service for the time being. So if you want to know how much value is being added in the agriculture sector in the entire process of making this a shirt, okay, final value of the shirt is 700, but how much value is added to that production in the agriculture sector or primary sector? Just 100 rupees. Okay, means you say in the process of production of goods and services, the value added in the agriculture sector is very less. That's why performance of agriculture sector is less, and agriculture sector's contribution to GDP is also falling down every year. Of course it is hovering at somewhere around 16 to 17%, and of course the number of people who are dependent on agriculture or the labor force that is engaged in the agriculture sector, if you see it, it is somewhere around 45%. And that's why, because the value addition is very less in agriculture sector, and more and more people are dependent on agriculture sector, or more and more workforce is there in the agriculture sector, that's why incomes of the people who are dependent on agriculture are less, and that's why there is distress in the agriculture. Okay, so what is the takeaway point here? We have to increase this GVA, gross value added, okay, at the primary level. Okay, at the primary level, or at this primary sector level or agricultural level, or there is a second way. Okay, you have to encourage these producers, primary producers, to enter into next stages of production. Maybe just producing fabric and cotton fiber and selling it. Instead of that, they may weave it into yarn and they can sell it. Then the value realized by them will increase a little bit more. Okay, if they are capable of, they can even make a fabric also, then they can try and sell it. Then the value realized by them will be much more. In that way, we can address the distress that is there in the agriculture sector. Okay, so you can take a lot of cues from here. That is, we are trying to do also by encouraging farmers to join in farmer producer organizations and add some value to their primary products, then try and sell it in the market, thereby realize more price and address their problem of poverty, backwardness, anything. Okay, that is the takeaway point. That is the usefulness of gross value added. I hope you have understood it and you will remember it. Okay, this is the important method. This is the most important method, I would say, and policy wise this method has a lot of significance. Okay, I hope you will remember this. Okay, if it clear for you, we will move forward and we will see the other two methods also. They are not that much difficult. Okay, they are easy only. Quickly we will try and understand it. Okay, right. The second method is, okay, the second method is B, income method. Okay, right. What is income method? Simple. I hope in the previous classes you have understood there are 4 factors of production. Okay, for producing goods and services you need 4 fundamental things. Okay, one by one we will write them. First one is land. I know, I'm sure that you know them, but still we will once again revise them. Okay, recollect. Okay, land means land and other natural resources are there like soil, water, etc. You require natural resources. Okay, then second one you require is labor. Okay, you need some workers or employees to transform the primary goods into intermediary goods or final goods. You need labor for that. And the third important factor that is required is capital. Okay, further capital can be divided into monetary component and physical capital and financial capital. Then in physical capital you will have buildings, computers, machines, etc. Okay, right. So capital you require. Then finally you need a person. Okay, you need a person who will take a risk. Okay, entrepreneurship we will write. Okay, you need a person who takes risks and pools the first three things. Okay, and starts producing goods and services. That activity is called as entrepreneurship or enterprise. That organization is called as enterprise, and the person who is doing it is called as entrepreneur. Okay, and each of these things have a return. Means when the entrepreneur is bringing all these things together, means he is taking them from somebody else. He has to pay compensation for them. For example, I am there. Let's imagine I am an entrepreneur. I want to produce fridges, okay? Refrigerators I want to produce. First what I need a land so that I can start my activity or start constructing some building and start purchasing machines, put them there and start the production process of refrigerators. Okay, for that reason I need land, right? So I don't have land, so I have to lease it from somebody who have that land. Okay, for that he will not give for free, right? So I have to pay some compensation to that person. So for the return for the land is rent. Okay, rent the entrepreneur has to pay. So the person who owns the land, rent is income for that person. Okay, the owner of the land, rent is income for that person. Okay, so remember, rent, it is an income for somebody. Then labor. Okay, so in order to produce refrigerators, I have to engage some people, okay, who has to work in the factory and transform the raw materials into refrigerator. So they will also not work for free, right? They also need some compensation. So what is the compensation for them? Labor. It is the wages. Okay, in normal language now we are calling them as salaries, wages. So wage is also income for somebody. For whom? For the labor. It is income. Remember, I am repeatedly mentioning the word income. Okay, this is income for laborers. Then capital. The entrepreneur also require capital. He doesn't have any capital, so he will get capital from somebody else. Okay, generally from where the capital comes? In nowadays it comes from the banks, right? Banks just like that will not give loan to this entrepreneur. So banks expect something in addition to repayment of the capital when the time comes. So they will charge interest. Okay, they will charge interest from the entrepreneur for providing capital. So this is income for those type of organizations or anybody else, any entity it can be. The interest is income for them. Okay, and finally, for taking all this risk and taking the risk of producing goods and services, the entrepreneur shall also get something, right? It's he or she will not be doing it for free. So they will take the profit. They will, when the product is sold, refrigerators are sold, or when the price of the refrigerators is decided, rent, wages, interest, profit is also included, then the price will be decided. Okay, cost of production, when you add these three things, okay, broadly, not all are mentioned here, but broadly the cost of production will come, then profit will be added to that, then the price of the product is decided. Okay, so if you see, these are the four factors of production. These are the things that are involved in production, and in the process compensation is being paid to XYZ people. Okay, these are the majorly or broadly, these are the incomes earned by people and firms in an economy. Okay, so you are trying to capture the incomes earned by all the people. So that is what is national income, right? You capture income of each and every person or each and every entity, you club it, then you will get the national income. So theoretically, how you will get income in income method, national income in income method? Simply you have to add these four things: rent plus wages plus interest, and finally profit. If you add them, you will get national income. That's it. National income is equal to rent plus wages plus interest, profit. This is the theoretical formula. I'm not saying NSO will use it in calculating the national income or GDP. It's very difficult to capture them. Okay, NSO has some different method. Practically they have a different method. We need not study that. Okay, you see, they will try to capture the salaries of the people. Okay, they will also try to capture the income of the self-employed people, like that. Some practical approach is there, different from the theoretical formula, and that is how NSO calculates it. Okay, right. So this is what? This is national income from the income method. Okay, it is also called as factor income method. Why? Because we are taking the four factors of production and we are looking at their returns or compensations for four factors of production, and we are adding them, then we are getting the national income. Okay, this is the second method. Okay, I hope you have understood this one also. Very simple, not that much difficult. Okay, then finally we have the third method, that is expenditure method. Okay, what we have finally is the expenditure method. Okay, expenditure method. Okay, so the Hanuman Jayanti, on the eve of Hanuman Jayanti, the procession is taking place, Shobha Yatra. So I can feel and hear the drum beatings and noise. Okay, it goes just beside our house. Okay, Right. Expenditure method we will look at. Okay. So in this you have to understand one thing. Okay. The expenditure made by somebody is income to somebody else. Okay. So this refrigerator, I told the refrigerator has been made. So some other person is purchasing it from me. So that income, it is income for me, and that is expenditure for that person. So you see, in the country or in an economy, if you want to capture all the income, it can also be done by capturing all the expenditure, because somebody's expenditure is income to somebody else, right? So if you can capture the expenditure, you can capture the national income also, right? So that is what expenditure method does. Okay. So if you see in the economy, there are 3 to 4 major areas where you will see the expenditure. So first is there are households. Okay. If you know this cyclical flow of income in 4 sector model, where households, then businesses or firms, then government, then external sector is there, rest of the world, then it's very easy. Expenditure method will become very easy for you. I hope you have already studied the circular flow of income in 2-factor model, 3-factor model, and 4-factor model also. Okay. So first we will take households. They will do expenditure, day-to-day expenditure for consumption. Okay. Purchasing food, purchasing oil, okay, going for a movie. This is all for, okay, all this is for consumption. Okay. So it's represented with the letter C in the economics. Okay. Household expenditure, it is called as household consumption expenditure. Okay. Consumption expenditure, right? Then 2, that is represented with the letter C. Okay. Second one we have is there is government. Government also does lot of expenditure. Okay. Government consumption expenditure, I will write it. Final consumption expenditure also you can write. Final consumption expenditure. Okay. How government does expenditure? You see, government has the responsibility of implementing various schemes. It builds infrastructure, roads, railways, etc. Then it builds schools and maintains them. It builds hospitals and maintains them. Lot of government employees are there. It has to pay salaries. All that is expenditure from the point of view of the government. Okay. Right. So it is represented with letter G. Okay. Then third one, we have businesses or firms. Okay. So it is firms also do some expenditure. What they will do, they will invest money and they will start a factory or build a factory, expand the already existing capacity, manufacturing capacity or production capacity. It is investment, but it is expenditure to them, right? So firms will do, it is actually called as firms from the firm side, it is called as gross fixed capital formation, or simply you can write fixed capital formation. Okay. Capital formation, it is represented with the word I. Okay. In economy. Then finally you see imports and exports will take place. Why we have to worry about imports and exports? Because we are trying to capture here the expenditure made towards the consumption of goods and services. Okay. So you see, in our country some goods are produced. Once again I'll take the example of these refrigerators itself. Okay. They are produced in the country, but not all the refrigerators are being consumed in the country. Some of them might be exported to other countries, right? There is a greater chance. Of course exports and imports will be taking place. Okay. The good is produced in the country but is exported to other country. So what is the meaning of it? The Indian people did not consume it, means it did not purchase it, means there is no expenditure from any of these 3 parties towards that good, but it is produced in our country, exported to other country. No expenditure is made in our country, but however, because it is produced in our country, to capture the national income, we have to take it into account. So we have to take the exports into account. Okay, then in the similar manner, some imports will also come into our country, right? Goods are produced in other country, maybe it is United States of America, UK. Nowadays more and more goods are coming from, of course, China. So lot of goods are coming, but you see they are not produced in our country. They have been brought into our country, but we have purchased them. Means we have done some expenditure towards them, right? Maybe the companies might be purchasing solar panels, okay? But spending has been done, but the good is not produced in our country. So we have to remove that effect or not, because the good is not produced in our country. So you have to remove the impact of imports to get the exact figure of national income in our country. So exports is resembled or denoted with word X, and imports is denoted with the word M. Okay, and generally we will take net exports. Okay, net exports, that is exports minus imports. Okay, net exports we will take here. How you will get net exports? Simply from exports you have to remove the imports. So if imports are more than export, you will get a negative figure. If exports are more than the imports, you will get a positive figure. Generally the experience of our country is the imports have been more, especially the merchandise goods are more than the exports. So always most of the times, majority of the times, this figure is negative for us. Anyhow, these are the expenditures and these are the corrections for the in the expenditure. Then the formula for national income is, the formula for national income is simple. You have to add the consumption expenditure by the households, then government expenditure, then investment, gross fixed capital formation from the firms, plus you have to add net exports from the country. Of course, I told when imports will be more than the exports, this figure will become negative, so the GDP will be lesser. If exports are more than the imports, of course the GDP or national income figure will be more. So you need not worry that much about them. If you have some logic about mathematics and you have some mathematical understanding, it will be easy. It's not that difficult. Right, this is the third method of calculating national income or GDP, and this is the expenditure method. I hope you have understood the three methods of calculating national income. In the other session, maybe I'll discuss some other topic, maybe the shortcomings of GDP. This is the next logical sequence for this discussion, the shortcomings of GDP and how GDP is not a better index or indices for showing the welfare in the country or the progress of the country. That area we will discuss. So this is it for